and welcome to a very special edition of Commodities Now right here on ET Now. I'm Mubina Kapasi. This is our special Diwali coverage of all that happened in the world of commodities. Now, interestingly, all commodity prices have recovered by the third quarter following steep declines that we saw in the year due to the COVID-19 pandemic. Crude oil prices, in fact, which by the way hit negative $37 per barrel in April, have more than doubled, supported by a cut in oil supply. But prices still are more than one-third lower than pre-pandemic levels. Metal prices have managed to recover rapidly in response to a faster than expected pickup of China's industrial activities. Food prices as well around the world have risen. Looking ahead, oil prices are expected to increase gradually from current levels and average $44 per barrel in 2021, up from an estimated $41 per barrel this year, as a slow recovery in demand is matched by ease in supply restraint. Gold prices, meantime, have of course been boosted by the pandemic and policy responses. But on the other hand, we have seen a surge in food prices. So lots, like I said, that happened in the world of commodities. But what are the big four events in the world of commodities during the last Samvat? My colleague Avan Dabas joins in.
Well, let's take a look as to what have been some of the biggest events in the world of commodities in the last 4 years. Well, let's just start off by talking about the kind of surge that we've witnessed in commodity trading. Over the last few months, the numbers really tell a tale, and especially within the months of June, July and August of this year, you've seen some massive traction coming into the MCX total volumes. Take a look as to what we've clocked in the month of June, about 6.2 lakh crores, July about 8.5 lakh crores, and August a whopping 9 lakh crores, and that has grown substantially month on month. Even in gold volumes, there has been a massive surge in the terms of the volumes, particularly in the month of August at 2.5 lakh crores, but even September has been stable at about 2.2 lakh crores. You saw June clocking in about 1.8 lakh crores. So clearly there has been a lot of traction in the trading volumes. But getting a move on, another big trend has been the way commodity prices have moved. People who don't even track this have definitely been noticing, waking up and taking notice as to how gold as well as silver has not just inched up, but has soared. Take a look as to what you've seen in by way of levels. Who would have thought that gold would have been valued at about 55,000 rupees and silver hitting prices of nearly 76,000. So clearly there's been a lot of safe haven buying that you've seen in these two asset classes during the global economic crisis. The unlimited money printing in the global central banks has been another factor that has aided this move. The fact that you've seen a major drop as well in the dollar index and a significantly undervalued silver has finally flexed its muscle, showed its might, and has seen a massive move. Number 3, as way of a trend, is crude oil prices. Without a doubt, that has been making the headlines, and theoretically you've had it sounds like the producers would pay buyers to take oil off their hands. We've seen levels of nearly $37 to a barrel. So a number of factors can be attributed to this: the sharp shortage that we've seen in oil storage as well as in tankers, as well as the price war that played out between Russia and Saudi Arabia. And not just that, the final trend that we've seen in the world of commodities has been the Baltic Dry Index, which has gone ahead and hit a one-year high. This despite the fact that we've seen a global crisis play out. There's been a lot of resilience despite the global trade, and that can particularly be attributed to China's increasing imports, which catapulted the shipping index. So these have been some of the key trends in the commodities universe in the last summer.
Thank you, Avan, for that. Well, let's talk about gold. How can we ignore the kind of move this shiny metal and a favorite among Indians for more reason than one has given? 55,000 rupees. And it's like Avan mentioned, the pandemic that's triggered this flight to safety among investors, lifting gold prices, which of course, as we know, is a safe haven asset. Further, even the US dollar has boosted this asset quite significantly. And then you also have the decline in interest rates. But can this asset continue giving great returns? Here are the global commodity gurus as well as ace investors sharing their view on gold.
I think gold, I am very bullish. Combination of factors, the biggest bullishness is, I think, that see a lot of the emerging world, China, Russia, They have large foreign exchange reserves, and I think for strategic reasons, they don't want to be, they want to limit limit their dollar exposure. So their percentage of gold in the reserves is going to go up constantly. Second, also, it's the best hedge in an uncertain world. And the fact is that a lot of people suspect that this low interest regime, they feel that, it's at 1% interest, 0.5% interest, better to hold gold. So I don't think the lure of gold is going to go away.
I would say in the current condition, silver is relatively inexpensive. Platinum is very cheap. The silver and gold, they will move more or less in the same direction. Will Google move up more than Apple, or Apple more than Google, or will Google move up more than Amazon, or vice versa? Who knows? It's like, I think at the moment, if we look at the relative value among the precious metals, I think that silver is more attractive than gold. But I have most of my holdings in physical gold and not in silver, because my safe deposit boxes are not big enough for the silver. I have to concentrate on gold and platinum. So, but I think as a trade, I think silver looks very attractive here.
I don't expect to sell my gold and silver for a long time. I hope that my children have my gold and silver someday. No, everybody should own gold and silver, and I expect gold and silver to do very well in the next few years because there's going to be more turmoil, more chaos in the world economy and in governments and with currencies. No, don't sell your gold, don't sell your silver. I plan to buy more when this current correction ends. I hope I get the timing well enough.
Okay, well, of course, pretty optimistic views largely coming in for gold and interestingly even silver as well. Now let's introduce on the show Soma Sundaram PR, the Managing Director for India World Gold Council. Thank you so much for joining in, and I think the question on everyone's mind right now is that will gold continue from here on at 55,000 rupees, or well, it's actually come off a tad bit from there, but nevertheless at 50,000 it's a little expensive to buy, so it's pinching a lot of people's pockets, but they want to know, is it going to be worth it? What does your prophecy say, sir?
See, there will be definitely a spike in demand because things have become much better than the Q2, which was a washout, Q3, which was a partial washout. Clearly, we saw a big drop. Q4, which is of the calendar year I am talking about, which is the Diwali quarter, we will see demand increasing significantly. But still, it is unlikely to be anywhere close to what we have seen in the previous years. Last year, this December quarter, we saw 194 tons. I don't think that level of sales you will see this quarter. However, it will be much better than the 86 tons we saw in the September quarter.
What's interesting is the fact that jewelry demand has declined quite a bit, and I think it was a bit on the lower side even prior to COVID. Now you have prices that are so expensive. We have the upcoming wedding season as well coming up. Do you think that jewelry demand will stay on a bit of a lower side?
Well, the price of 50,000 has been breached long ago, and that definitely puts pressure on the wallets of people, particularly at a time like this when your income anxieties are much higher. So there will certainly be a lot more thought going into buying a jewelry which has a higher labor charge. So you would therefore definitely see more people flocking to buy a bar or a coin where the charge, and in addition to gold, will be much lesser. We saw that in Q3, and I'm sure we're going to see that in Q4. In any case, Dhanteras is a time when most people buy a lot of coins. So you will see that jump happening. But you will also see jewelry, purchases coming back because weddings are coming back, a little bit of celebrations are coming back. So you will see jewelry purchases coming back. But yet at these prices, people would want to buy more gold with the same amount of money. And that can only be offered when you have a bar or a coin.
All right. Mr. Somasundaram, now, we have the upcoming festival of Dhanteras, which is, of course, considered very auspicious to buy gold. But would you recommend our viewers to go a more modern way when it comes to buying gold? That's buying ETFs or subscribing to the sovereign gold bond scheme as well, that's open for subscription over, the usual coins and jewelry?
Well, they are already doing that. Many of the organized retailers are giving you experiences on the digital front, which have not been heard of before. Clearly, some of this will stick even in the post-COVID era. But whether they should completely go with this type of buying is, I would probably not... I wouldn't see this happening in India, because see, gold buying is both an experience of buying as well as wearing. You can't remove one and just say that, buy it all digitally. Digital is there to stay. Digital engagement, digital buying, digital online buying is there to stay. But I doubt it would ever overtake the brick and mortar style and people going with families and friends and, looking at various designs and buying. That's an experience in itself, and that can't be removed from gold.
Well, Mr. Somasundaram, it was lovely having you with us. Thank you so much for joining in. Okay, well, shifting focus from gold to oil. While gold did see a rally to record high levels, oil saw a downtick to record low. And when I say record low, I mean negative $37 per barrel, a phenomena that all of us wouldn't have even imagined just 1 year ago. The collapse in oil consumption in March and April because of, the sharp fall in oil prices in turn. And in response, we saw many oil producers cut production. Most notably, of course, is the OPEC and its allies. A record cut in production is what they agreed upon at almost 9.7 million barrels per day. That's 10% of the global output. But the CEO of British Petroleum, Bernard Looney, believes that oil will be around for decades. And yes, oil demand may have peaked, but that is not the end of the oil story.
People confused peak oil demand with somehow the end of oil growth with somehow the end of oil. And that may be wishful thinking in some people's behalf, but the end of oil growth, whether it happened last year or whether it'll happen sometime this decade, does not spell the end of demand for oil. And oil will go on to be a considerable part of the energy mix for many, many decades to come. And there will have to be an incredibly capable oil industry to make sure that we invest into that, to make sure that that is the best that it can be and it has the lowest emissions that it can be. So yes, it's garnered a lot of debate. They are scenarios. There are as many scenarios that say it already peaked as the scenarios who say it'll peak in the future. And peaking of oil demand does not mean the end of oil. Oil will be around for a very, very long time.
Okay, well, we've touched upon gold, we've touched upon oil, but guess what? The commodity complex story is not yet over. So we'll do one thing, we'll take a very short break and we'll be back with lots more. You're watching a very special coverage of our commodities show for this Diwali. Now, we spoke about crude, which have managed to double, in fact, since their April low, supported by the sharp cut in oil supply. Gold prices as well have surged to 55 but come off from there. And now it's time to touch base upon metals. Those prices as well have recovered rapidly in response to a faster than expected pickup of China's industrial activities. So let's take that point forward, and I have with me Paul Bartholomew of Platts. He's a senior managing editor of S&P Global Platts. Paul, it's lovely having you with us today on the show. So last year was a very eventful one. We had the China factor. We have the fact that, economies are going to continue pumping good amount of money into infrastructure to sort of perk up the country's GDP. So do you think that metals will continue to be on this good ride that they were in 2020 for the next year as well?
Yeah, I think most markets and most countries are expecting and hoping to get a lot more in the shape of infrastructure investment. I mean, people are already talking about the implications of Joe Biden becoming the president of the US, and people are expecting a big infrastructure push there. But there's still quite a lot of hurdles with a divided Congress, and they've still got to agree to who's going to pay for it. We've certainly seen that in China. We've seen a lot of infrastructure spending. And we expect that to carry through into the first half of next year, supporting metals prices and steel prices, and also in India. But I guess it's really comes down to can the respective governments afford to roll out an infrastructure program, because it's not that easy. You need sort of fairly deep pockets. But infrastructure stimulus is a surefire way of uplifting the economy, particularly as it comes out of the impact of the pandemic.
Paul, what about the China factor? We already have a lot of consumption, a lot of import by China of metals. But where to from here? I mean, will the China factor continue keeping prices up?
Yeah, well, China's been extraordinary, really, because it carried on fairly strongly all through Chinese New Year, and then obviously went into the lockdown. China was the kind of first into lockdown; it was the first out of lockdown, but it sort of carried on rallying, and then they had the Golden Week holidays at the start of October, and we came out of that holiday and rallied yet again. I think one of the reasons was that. The Chinese government loosened credit conditions, so traders and steel mills, for example, they had a lot more sort of cash, so they didn't have to kind of destock their inventories and things like that. But I think next year, 2021, is the first year of China's 14th five-year plan, and they'll definitely want to get off to a very, very strong start there, having had 2020 sort of impacted by the pandemic. But if you look at manufacturing in China, that sort of rallied back incredibly strongly in recent months, and property construction we expect to be softer over the next year, but still fairly robust. So I think all the ingredients are in place for a very, very strong first half of next year. So I expect sort of metals prices, iron ore, strong steel production, I expect that to continue through most of 2021.
The new focus area then within metals, the entire EV space. Do you think minerals like cobalt, nickel will do well?
Yeah, actually, I think the outlook's pretty good for those metals, really. But particularly, with a Biden administration, the thought is, or the expectation is, that the US will sign up to the Paris Agreement. So that will probably lend support to the NEV space, which will in turn, support copper and nickel and other prices. And also, the Chinese government has made targets to lift its proportion of electric vehicles and NEVs as part of its decarbonisation process. So I think actually the outlook for sort of battery metals, for copper, for nickel is a lot stronger sort of looking now than perhaps it would have been this time last year, when we saw some of the demand and some of the sort of excitement about that part of the market actually coming out. So yeah, I think they're going to be fairly well supported. Copper's obviously sort of run up a little bit on the back of macroeconomic factors and some supply shortages in parts of South America, for example. But I think the outlook for the NEV sector is actually pretty positive again now.
Paul, pleasure having you with us, and it's lovely actually to see you dressed up in your Indian wear. So wish you as well a very happy Diwali, Paul, from all of us from ET Now. Okay, well, moving on, just ahead of Diwali, guess what? There is a run-up in food prices. From spices to vegetable oils, we are seeing a massive surge. Incidentally, Indian mustard prices are already at an all-time high. So what exactly is causing this rally, and can we expect continued rise in food prices? Here's a special report. Food prices have been on a tear. In Chicago, a futures contract for soybean has jumped to a 4-year high. Palm oil prices have rallied to $800, and even a futures contract for orange juice has seen a big rally, especially when the pandemic broke out. And this price rally is seen back home as well, especially in the edible oil space. Indian mustard prices are at all-time highs. Indian soybean prices are at a 5-year high. The factors for this rally in edible oils has largely been global.
Main factors were lower production in the key origins like Malaysia and Indonesia. The production was almost stagnant, and also there was immediately after the lockdown in most parts of the destination markets, when HoReCa started opening up, when the lockdown started opening it up. There was a lot of pipeline depletion that has already happened. So there was a huge pipeline demand, Chinese demand. This is a reason, main reason is Indo-US uncertainties. So China started buying a lot of soybeans from Brazil. So then Brazil got the stock out.
Interestingly, Sudhakar Rao Desai also believes that the prices may not go down in a hurry.
While I don't see prices to rally bigger, they should stabilize. But I wouldn't rule out. I don't really see whether the prices will retrieve about 10-20%. I just don't see the reason. But up to Jan, Feb, March, market fundamentals based on all these factors looks like still friendly to the market.
It's not just vegetable oils. Spices like dhania, turmeric, guar gum, chana have all seen massive rise in prices. Noted commodities trader Ajay Kedia notes the tendency of agri-commodities, especially food prices, to rally on every disease outbreak in the last 20 years.
Generally, we have seen in last 20 years, whenever there is any hit of pandemic, generally food inflation rallies. And this time also we have seen people started holding these major commodity. That was the one reason.
So what are the foods and other agri-commodities that could see a rally in the next somewhat?
First of all, we expect a continuous rally would be there in spices as compared to any other agri that has been slightly lagging behind. So our top pick would be jeera. No doubt last year there was a bumper crop, but now consumption is now picking up, export demand is picking up. Prices has already made a bottom of around 13,200. So I think buying near to 14,200 is a great level to buy. Second would be guar seed. We have seen a strong rally from 3,200 to almost 4,200 level. Carryover stock has been slightly dropped, and area under cultivation this year has been slightly lower as compared to previous year looking to the prices. Overall, we expect cotton could be the next commodity. We can see prices moving towards 22,000 also.
This rise in food price may make this Diwali a little tougher than it already is. But if you're an agri-commodity trader, the new Samvat may perhaps give you a chance to finally taste some profits. Okay, well, with that, we are all out of time. So many thanks for watching this very special episode of the Year of Commodities, and wish you all season's greetings.